Live. I got Moses here. Moses and I have interacted and conversed over probably the past year or so. He writes an incredible newsletter, Random Walk, which is would you say it's like capital markets centric, but like industry agnostic, kind of generalist?
Y- Yeah, I think it's generalist, a little, macro thematic
Hmm.
stuff. But I do try to chart through lines to specific asset classes, and to me, it's like the big enduring stuff that should drive capital flows.
Hmm.
Um, but yeah, it covers a lot of ground.
Yeah. Um, so yeah, I mean, recently we had sort of an exchange of comments on housing. I've read some of your stuff on housing, and I kind of want to start with, what we've been starting with off the top is just sort of the characterization of the current state of housing as a crisis. You've made it clear that it's not, nor is it a shortage. Um, if you were to be completely charitable, as charitable as you can be towards the purveyors of the crisis narrative, what would you say are the problems that exist right now?
Um, that's a good question. I guess I would break it into three chunks. I mean, and they're sort of overlapping, but they're not the same. Thing one is just like to get sort of the easy YIMBY objections out of the way. Like, I think it's plainly true that there is probably more regular. I mean, I'm not a big fan of regulation in general. I just think it generally
Mm-hmm.
adds more friction than necessary. And housing, especially in like already dense places, is probably they're probably throttling supply in
Mm-hmm.
excess of what demand would support, and that probably does contribute to slightly higher prices. I think on the hierarchy of things that make housing tricky right now, it's fairly low, and people put a lot more emphasis on it than it deserves, and I also think it's like a heterogeneous problem, like
Mm-hmm.
so let's call it single family. In other words, like if the kind of inventory that people seem to really want, both by like revealed and stated preferences, is precisely the kind of single family suburban home, like the extent that people want to upzone the suburbs, like that's almost an exactly backwards solution, right? It's like, well, people are leaving density because they want something less than that. So let's make the suburbs more like the density that people left behind, is the kind of prevailing instinct that you see everywhere. And it's just to me, it's just incredibly stupid. And sometimes motivated, I think, by bad reasons. But anyway, so that's thing one. It's just like, if you wanted to, I think, putting aside the aesthetics of it, like if somebody said we should pave over Park Slope or something like that and build high rises there, I think that's, a more defensible
Mm-hmm.
kind of YIMBY view. Um, Thing two, in terms of where, it's also, I'm sympathetic, is just like, I do think part of the affordability issue that people are perceiving is our interest, is the mortgage subsidy that people get, and the way that
Mm-hmm.
it's been structured, as a 30-year, interest hedge basically for free.
Yeah.
And if you got it, great. If you don't, then you don't get that extremely discounted coupon, and you're at a major structural disadvantage relative to the
Mm-hmm.
people who did. That's why I say, like, if you really wanted to unglue the housing market, you just would do away with the 30-year mortgage, and it would function a
Yeah.
lot more like, the commercial side, which of course have seen pretty substantial markdowns because they don't get 30-year debt. They get 5-year debt or 3-year debt or floating rate. So
Mm-hmm.
things reprice when interest rates change. The last thing I'll say on that, and we can dig into any of these, is like where I think the real shortage of the shortage isn't in roofs overhead. It's not like I mean, there are homeless people, but that they're not homeless for lack of places to stay. It's a different problem. It's just that we do have, I think, a shortage of places people want to live.
Mm-hmm.
It's like I make this line a lot, but it's like, don't. And again, I'm indexed to the Northeast because that's where I live. But I'm sure you can find example of these everywhere. It's like we don't want to build more high rises in Westchester or high rises in Bergen County, New Jersey, whatever it is. We want more Westchesters.
Mm-hmm.
And that's a much harder problem. Because I think some people have been focused on is like, how do you get, how do you get the critical, how do you build new places that people want to live? And that's, it's as opposed to
Yeah.
just like go ahead.
Yeah. I was going to say, that's an interesting conversation around sort of property taxes. Texas has this structure, that referred to as MUDs, municipal utility districts, and within the Constitution, it allows for sort of this financing structure where a new municipality can form or can be annexed to an existing one, and the local, government can then sort of raise property taxes with a time horizon, maybe 30 or 40 years, issue revenue bonds, or not revenue bonds, but issue municipal bonds to finance the development, the infrastructure, the utilities, pretty much everything. And then those municipalities have higher average effective tax rates, and so the home prices themselves, that's capitalized into the home prices, so it's pretty affordable to actually move into these communities, and it's been a pretty successful model for Texas. I think there's like 1,200 of them throughout the state, 600 around Houston alone. Um, I think, if you contrast that with California with Prop 13, and um, not only do you have what you're referring to, the rate lock in effect, but I think there's also, and I've heard some anecdotes, and also I think the research supports this, that there's this lock in effect where people who might have purchased a property in the 90s or even 2000s, property taxes are like the appraisal value can't go up more than 2% a year, I think it is. Um, and so when they sell, then it gets reappraised and taxes go up. So there's sort of a locked in effect there as well. Um, yeah, yeah. I mean,
So I don't.
I
It's funny. I don't. Go ahead. I'll finish your thought. It's
well,
your.
I agree with you. I wonder if you think that there have been, uh, let's call them the superstar cities, the superstar metros. Have we seen some fall off and then others gain more prominence, where there's fewer superstar metros than there were previously? Would you say
I
that's the
think.
case?
I don't know that there's necessarily fewer. I think there is something cyclical to it. I don't think there's there's not a single answer to that. I mean, yeah, we've definitely seen what I call the old centers of attention. There's been a shift. I think this is pretty consensus now. Like, and still true, is just there is net demand pull to places like the Sun Belt. Sun Belt broadly defined in Florida, North Carolina, Tennessee, Texas. That
Hmm.
we know that there's a gravitational pull there and away from say legacy Acela corridor cities like New York, Boston, which still have a very valuable molten core, but like these cities, they're getting older. The people, the comptroller, New York City comptroller puts up these great reports, and like you can. I think actually the Economist wrote one up recently, sort of very random walking themes, but like if you look at what happened to New York, and it didn't start with the pandemic, although the pandemic sort of accelerated it and made it a bit more salient. It's just like you do have the new jobs that are being created in New York predominantly are like healthcare jobs, which are low paying jobs.
I saw that.
Um, yeah, and most of the other, there's been very moderate growth, and again over a 5 year period, incredibly slow growth. It took 5 years for like finance jobs to exceed the pre pandemic level.
Mm,
But otherwise, like the big job pull has been help, senior care. And like, as New York is
mm,
getting older, and so Boston is getting old, Northeast is getting older, parts of New Jersey too. And like, healthcare drives a lot of hiring, and it drives a lot of new entrants. And then, sort of related is then you get retail and, you know, quick serve restaurants and discount stores that then pop up, to serve that slightly lower income population.
mm,
And that's been the story of growth in both the Northeast, but also frankly in Florida and Texas too, to some extent. Um, so I don't know that there's necessarily. I mean, I think like North Carolina is pretty well situated. It's been that star has been burning brighter relatively than to the past.
mm,
You know, but like it's sort of one of my occasional rejoinders to the NIMBY people. It's like San Francisco, LA. San Francisco's actually done a little bit better recently, but like LA home prices have gone down too. People maybe some of that's attributable to the fires, but also like there is some dysfunction there, and
mm,
um, a lot of people have left California for Las Vegas. Nevada is a popular destination. But and I think my general view is actually like supply and demand in housing is pretty agile. It's pretty responsive. You know, it's about as responsive as a capital intensive product like real estate is going to
Yeah.
be. I mean, it's not instantaneous, but and I think builders build to the demand flows, and that's been. I mean, yes, it's easier to build in Texas. There's more space there. Regulation is more favorable, but there's also more people coming to Texas than there
Yeah.
are.
Yeah.
You know,
The
New York.
finance and tech industry, like there's been, um, you know, remarkable growth in both of those sort of job centers, especially in Austin with tech and Dallas is finance. What do
And
you?
it's younger and their families and they're having kids. Like, New York is getting
Mhm.
older and there's fewer families. And, the organic driver of, people, the way people sort of talk about the housing shortage is almost like, oh, you just have to build more supply and then magically demand shows up. And it's not, it doesn't quite work like that. Um,
No, like
yeah.
the San Francisco working paper, the Louis Madrigal, basically it contrasted the Glazer research that has been culminating over like the last 2 decades, saying that supply constraints matter, land use regulations are, introducing this regulatory tax of 25 to 40% in some areas. Well, this new study found that there are no meaningful differences between supply elasticities from one metro to the next. Um, meaning that like if there's a demand shock in San Francisco, they will find a way to meet that housing demand, even if it's in if that development is concentrated in certain areas that have lower you know
Yeah.
regulatory constraints. So that is to say that like supply elasticities have been shown like pretty conclusively to vary across neighborhoods within a metro, but not across metros, and that the ultimate driver is income.
Yeah,
Um,
it's net new people and higher income people. Like
mhm,
Miami is good because Miami is a net loser of people, but it's a net grower of wealthy people. So like
mhm,
Miami loses people, but it gets more expensive because it gets more exclusive. Right?
totally,
Like
and
that's different than New York. Yeah,
yeah, and people have this like percentage of their you know of their income or of their net worth or whatever it may be that kind of remains stable as their income or their wealth goes up, and so it's not like other normal goods. Um,
right.
yeah,
It's right. People
yeah,
pay about 30% of their income, like
mhm,
accumulated towards housing, and how that you break that 30% up, and this goes back to the interest rate points. Is like if some of it's going to be spread across principal, some of it's interest, and some of it's insurance, right, and
mhm,
taxes. And like if you jack up one lever, which in this case is going to be the interest payments, it takes away from the part of the pie that you can attribute to principal payments, and which mechanically ought to drive home values down as it's done in like on the commercial side, right?
mhm,
Any institutional investor has had that effect. But on the home side, it does manifest. It shows up in the builder market, new builds, right? Because
mhm,
they build and sell and price to market, and their margins have been compressing in some cases to like 2008 levels, which is pretty incredible.
right for Lennar, right?
Yeah, and and Pulte is also getting close, and these guys, they've been incentivizing and discounting and building smaller homes with smaller footprints more cheaply now since rates went up, and that's exactly what you would expect. And
Mhm,
um, but in the existing home market, the used home market, so to speak, where the premium between new and used has disappeared, and it's not, I think,
yeah,
because people like the used car, the used house smell kind of thing. It's just that existing homeowners, for them, asset value, it's both a commodity and an asset, and they don't want to. Its prices are sticky. They don't want to sell if they don't have to because they would have to realize a
yeah,
loss, and
and
all
I
those
think
unrealized. Go ahead. Yeah.
sorry, I think another effect there is probably, especially over the last 3 years, as it's been harder and harder to list and get a bid at the ask, basically.
Yeah.
I think you've seen people sort of perhaps turn into accidental landlords, but um, also basically like just renovate their house or do something instead. Well, I mean that was like more of a pandemic era thing, but yeah. So I wanted to get your take
What
on
what you've seen is just that the volume of sales in the existing home market has collapsed.
totally,
The
yeah,
and again, it's not the demand has changed. It's just the bid ask is too wide. And in any
The,
other asset class, if you saw, volume collapse because the bid ask spread was too
the
wide, and
price
you don't
discovery diminishes.
right, and you don't just say,
Hmm.
well, you don't just find price discovery in the few deals. It's like if you went to a car salesperson, they said, I'm not selling anything except for an occasional high end luxury car that somebody walks in and pays all cash. You wouldn't then say, oh, I guess the values of all cars have gone up. It's like no, of course not. You're,
Hmm.
there is there's a and part of why it's true is because people often tell the story from the perspective of the buyer. They talk about the affordability issue. It's like, well, homes are 20% out of reach, and like, well, what does that say about prices? If everybody's
Hmm.
listed price is way above anybody's ability to pay, then eh, it's not
So
a real price. I don't know. Yeah,
do you generally see prices as sort of responding to rents in the DCF sense um, where the
for
price of an asset should sort of converge on the value of its the present value of its future cash flows.
relative to the risk free rate. Yeah, I mean, you definitely see that in
Yeah,
commercial real
yeah,
estate for
discounted at
sure.
the yeah. It seems to me that we haven't really seen that response in home prices to falling rents in a lot of cases, or maybe there's a divergence there, and I think this kind of speaks to, I mean, like Melody Wright talked about, like anecdotally rage delisting, where people are looking at their estimates, they list, and there's just zero interest. And they still psychologically in the back of their mind are thinking of that like high watermark in 2022. Um, so it just seems like there's a lack of price discovery in the existing home market. Um, and you made a lot of good points on this. I mean, the rate lock-in effect obviously has a lot to do with it. I mean, in other countries, we don't really have the 30-year mortgage, I think is the sticking point here, right? Because
Yeah. So I like to
um
say on the rate lock-in effect is like if anybody's locked in, it's the banks. It's not homeowners. Banks are locked in, and those losses sit as everybody's seen the scary chart from the FDIC, unrealized losses on bank balance sheets. That's what those are. Those are home price declines that sit as the price of debt that is generating 2.5% or 3% that is way under
mhm,
market. Homeowners are insulated from that. Yeah, they have no debt. Like, again, like 40% of homes have no mortgage at all. And still the majority of outstanding mortgages are way below market rate interest. That doesn't flow through to the homeowner. So
mhm,
if they don't have to realize that cost change, then they have the option of just sitting on the asset and waiting for a better time to sell.
yeah,
But again, if you talk about does it feed through to rents, is like if you look in institutionally owned commercial real estate, it absolutely does. And those
yeah,
things have traded hands and they've repriced substantially and is beginning to stabilize a little bit. Um, but of course, and then there was a paper that I wrote about a while back, and I go find and remember the exact details. But yeah, it did compare. I think it was England and maybe I forget what the other jurisdiction was, but yeah, basically 5 year where they have 5 year mortgages and not 30-year mortgages, and lo and behold, prices begin reset substantially or and around the 5 year point, even a little bit earlier, which is
mhm,
exactly. And what I find like sort of funny and frustrating about this is like I'm not making some super contrarian novel argument that if interest rates go up, asset prices go down, right? I mean, I have this running theme of like, the marks are too damn high. It applied to cars, it applied to houses, it applied to,
mhm,
to private equity, it applied to public equity to some extent. And actually, like the idea that somehow houses should be accepted from that dynamic, that's the contrarian thing that ought to bear the burden of proof. And it just doesn't,
mhm,
I don't think it does. But yeah, so it's like, there is and again, all the things that you would expect from this dynamic is like, well, okay, you know, that existing like if existing home sales continued at their pre-pandemic volume and prices were still flat or up, then I think that would be evidence that I was wrong, right? But like
mhm,
the fact that existing home sales have collapsed, um, you know, and in some places values have gone down, or at least they've been flat to down for the last couple of years. And yeah, all of those little anecdata like, that walk away, but, buyers are ghosting, sellers at historically high rates, or deal
Mm,
breakups are historically high rates, or the share of homes selling below listing prices are higher than they've ever been. The number of concessions and price drops are
yep.
higher than they've been. Like all of that indicates, I think, to me, it validates what I'm arguing, which is just
Mm.
like the affordability crisis, such that we have it, is not has nothing to do with NIMBYism. Um,
It's a
unless there
market
was some.
responsiveness
Yeah, it's a
problem.
30-year mortgage.
Hmm.
It's the way that we subsidize homeownership for individual homeowners. Against the backdrop of a very dramatic rate shift, that basically that caused a massive bid ask spread
Hmm.
widening that homeowners don't have to internalize. They can just sit there.
Yeah. So
Um,
so let's talk about that. Let's talk about uh, you know, as we all know, the implementation of or the sort of standardization of the 30-year fixed rate mortgage through Fannie and Freddie, who kind of de-risks these mortgages for banks, and by packaging them up and securitizing them and turning them into sort of liquid tradable products. Um, and
and
so
and
the
creating a set and forget demand for them too. They basically said, if you
mhm,
originate them, we'll buy them.
yeah,
Yeah.
yeah. And the reason for that, is banks on the one hand uh, have demand deposits that pay out variable rates, and so they have like sort of rate sensitivity on that end. And then on the other end, if they were to house a bunch of 30-year fixed rate mortgages, then they open themselves up to serious like rate risk, right? Um,
Sure.
and so
SCB
so I
First Republic will be the first ones to attest, right? Yeah.
yeah, yeah, exactly. And so and other countries don't really do this. Um, it seems like we're the only one. Um, I wonder if you've thought of any alternatives to the current mortgage structure. I've heard the idea of like a variable term mortgage thrown around sometimes, where the sort of the monthly cash flow stays the same, the duration, uh, or sort of like the termination date of the mortgage shifts periodically with changes in rates. What are your thoughts on um, sort of the de-standardization of the 30-year fixed rate mortgage?
So, I mean, I don't have very evolved thoughts on like particular proposals, because in some ways I think that, again, I haven't looked too closely, but to me, my instinct is that they're all kind of beating around the bush, and it's just like subsidies, which is that's what the
Hmm.
30-year mortgage is. Subsidies are inherently distortive, right? Like,
Yeah.
if you subsidize demand, prices go up. Um, and there's a broader question of just like, can you subsidize a thing forever? And I think we're finding out the answer is actually no. It turns out we can't. Or at least, in order to subsidize something forever, you have to continue to grow, your base of, revenues, just that you can continue to afford the subsidy. Otherwise, the subsidy begins to overtake your revenue base.
Hmm.
Um, so like, that's almost like a more fundamental issue. Is like, why can't we infinity print 2.5%, mortgages for whoever? And like, well, because we're discovering now that there are some problems to that. So to me, it's more like it's grappling, it's grappling with that realization, which is, and again, I'm sort of, I'm a little bit more nuanced in the kind of shit on the boomers and blah blah blah, all that stuff. But like,
Hmm.
we did subsidize, maybe for a good reason, basically since World War II until, even until now. It's like, we've subsidized individual home buying, and maybe that's good. Like, and maybe it gives local skin in the game, and, gets people their own piece of America that they own, and they get to share in the equity. But like, the idea that rates might then change, and then it would, erode that subsidy for later generations, just has to have been baked into the price of that. And it's almost like
Sure.
we didn't. You can say the same thing about healthcare and all the other things that are, Social Security, that are slowly bankrupting us. It's just like, when, you can see it on steroids in Europe. It's just like, when these deals were struck, and when we created the safety net, it was a very different underlying dynamic. The
Hmm.
recipients were a much smaller share. We were growing, and everything was roses and we could afford it. And then over time, um, that has shifted. So like to me, that's the kind of more of the threshold issue than sort of tinkering around the edges with the mechanism. Like like again, if you wanted to just blow up the 30-year right now, it'd probably be illegal. But let's say it wasn't, like, or you gave it a 2-year clock or something, like we're just going to reset these all as arms. Um, the housing market would unglue in a hurry.
Mm,
People would, and you would see prices reset probably as 20% lower than what they are, just based on simple DCF.
right.
Um, and that then you would have a good, a more accurate clearing price. Even then, though, just as a side, like, because I make this point a lot, is because one of the things I really find frustrating about the discourse, so to speak, is like nobody ever really articulates a good theory of housing values. It's like what I call like the hydrothermal sea vent theory of housing values, that it just kind of like starts spouting up somewhere, and then the goal is to stick as many barnacles until it gets
Uh,
depleted, and then you find a new vent. It's like,
right.
oh, it drives how, housing values. First of all, is heterogeneous across space and time, right? Like when you're
Mm,
in your 20s, you want to live in a dense, urban environment with lots of serendipity, lots of chance encounters. Like you don't need safety, trust, like those kinds of things. But like as you begin to get older, like you put higher premium on trust. So certainly if you have a family, and also like your network might be established enough that you don't need all those chance encounters, and you can afford to be a little bit more gatekeeper. So the things begin to shift.
mm,
And if you find that, like, these nice little tree, suburban areas with, single family homes, and where you see property values begin to jump, to me, what that's telling you is that that's what people want. And that's what we have a shortage of. And putting dense multifamily in those areas, like, that would bring prices down, but not for a good reason, right? That would just change the product. And that's actually
well,
not, that's, yeah.
it's an interesting idea. This idea of like whether that creates negative amenities or positive amenities, densification, that is. And a lot of research kind of shows that it varies case by case. I mean, on the one hand, you have like gentrification effects. On the other, you have sort of more heads per amenity or resource, which drives down the value of those resources. Um, so it's an interesting discussion, and it's like this idea that like the the Glazer supply constraint school of thought, like where it does reconcile with the latest research, is that, like I said, within metros you have different neighborhoods with different supply elasticities, probably due to geographical constraints, land use regulations, etc. And it creates these. I'm wary of the term spatial misallocations, because I don't know that it's misallocation is the right way, but it reallocations, or spatial, like land use constrained allocations, let's say. Um, and so I wonder, I think like what the research needs to prove is whether those uh, have negative welfare effects. Do you know what I mean?
Right.
Where, because
And for whom, right? And for whom,
for
and
whom?
for over what period of time? I mean, like, it's like, again, if you were going to college, right? You wouldn't want a college campus with lots of little single family home. I mean, maybe some people would, right? No, you want to live in a dorm. You want to live. You don't need a lot of personal space. You want to live surrounded by lots of people. You don't need to put your kids anywhere. Like, you don't really care about, your kids getting, home safely from school. You don't even care that much about yourself getting here. You're stumbling home drunk at 4 o'clock in the morning, whatever it is. Like, that's what you're putting a premium on. But that changes. The other thing too is like exclusivity. The bid for exclusivity, for being in the most, in the fanciest place, that will always be there, and there will always be. There's positional
Mm,
status too. It's like zip codes have a signaling effect. People like to say they live in one neighborhood rather than another. They want
mhm.
to be, it's like the friend paradox. Like we all want to be friends with people who are higher status than us.
Yeah.
It's like we all want to live in a neighborhood, that is where everybody's a little wealthier, kind of thing. That's like
Mm.
um somewhere in the middle, but like, and that's
Upgrade your
always going to
circle,
be.
bro.
Yeah, pretty much, yeah, exactly. But like, it's real, and and you
Yeah.
begin to think about, how do I generate opportunities whereas you are the average of your five closest friends, like there's some truth to that, and it extends even further than five. It's like if you think, how do I want to generate opportunities for myself, for my kids? It's like, well, I want them to be with other people of XYZ criteria. There's the birds of the
Mm,
feather flock together thing is just real. Um, and certainly with education and things like that, it's like you want why does everybody again, like, Harvard, if Harvard 10x its admissions rates, like, would it still be the same thing? Like, they might have the same faculty and do the same classes, but I think it would erode part of the value, which is in exclusivity and skimming the cream off of, some human capital, so to speak.
mm,
And I that's the other again, like I don't, it's not necessarily politically correct but like it just is, right? And that's partly the value that people find in housing is to be in places that other, where price plays a gatekeeping function. That's part of the value that people want. And everybody wants. I just so I
mm,
think that's fairly ubiquitous. So it's like it's on the quality of the amenities, right? It's the old Yogi Berra line, like nobody goes there anymore. It's too crowded.
mm,
Um, like that's another part of it. And again, shifts over time. Like when you're, a young bohemian, like you might have the opposite. So you want to live somewhere
mm.
dirty and, go to Brooklyn or something and be a little bohemian and that, that has its own signaling effect, but that does
So it
change.
also has to do with like the composition of demand and how that shifts over time. Yeah. Um,
And that's like
so
kind of
many
an
cross
interesting, it's
currents.
like, and like, I love this stuff partly because again, I'm a Northeast kid and like, you look at and there's sort of 2 points to be made is point 1 is like what everybody kind of wants is they want that sort of mid density, the park slopey. They want the density that was achieved in the land booked in the time before cars, right? Like,
Yeah.
they want New England town, or something like that. But of course it's like, okay, well, where else are you going to build that kind of thing in these parts? No, I don't know. Like, I don't know that there's space for them necessarily. Um, and also, we do live in an age of cars, so it's a little bit harder to sort of organically create that kind of density. Although, like cul-de-sac is an interesting experiment, in Arizona that's tried. Um, and the other part of it is you see, like where I grew up in New Haven, or like you see housing inventory that is almost like it's like a civilization. It's almost like a lost civilization. Like the people who built those homes and the needs that they had, they're gone.
Mm,
And a lot of these single family Victorian, like the home I grew up in, is like a single family Victorian home built, around the turn of the 19th century, 20th to 19th,
mm,
had a Georgian stained glass window in it, and the sort of the house built in the Queen Anne style. And like that's just to
mm,
give you a sense of what was happening, but when I grew up, none of that, it was kind of like it was like a sort of an upper middle class when New Haven was still an industrial and trading area, right, for the
mm,
Northeast. But they all moved, right? I mean, they all dissipated, and the houses they left behind, which had, big sitting rooms and places to entertain and, with churches nearby, like that, the uses and, they over time they either got knocked down or they got turned into this, split families and, some of them turned into student housing and like it just and there you see that and I think about that too, like in the Northeast, all these palatial empty nest homes, what's going to happen to them when people finally do age out? Who are they going to sell them to? Like, then it's not, there's fewer big families. Maybe they get chopped up and turned into almost, it's almost history repeats, right? These things get, you said boarding homes. Then we made boarding houses illegal, or maybe for good reasons. I don't know.
mm.
But maybe that day will come back. Yeah. Sorry, that was a bit of
Yeah.
a ramble, but
No, 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 no. It's fascinating. And I think you do see that in many parts of the country. I know that's the case in St. Louis, where I used to live.
yeah,
Um,
another great example. Yeah.
yeah. Um, I want to go back to mortgages. Uh, I've been thinking just a lot about like what could be done um, to sort of alleviate the lock-in effect to the extent it exists right now, uh, without creating a financial market shock. I wonder if I haven't heard this thrown around, if like the idea of a portable mortgage maybe for like a preordained period of time, like for the
Yeah,
next 12
the
months.
assumable mortgage.
Yeah, based on your equity, or the sale value of your house, you have the same, that mortgage has been, or the value of your mortgage, it can then be transferred over to a new asset, underlying asset. And
Yeah,
um
so to me, the assumable mortgage, people like to tout the assumable mortgage thing as like as a kind of fix. I don't buy it. You know, again, 40% of homeowners don't have mortgages at all. So I think the lock-in effect is it's more sticky prices than lock-in. But to me, the assumable mortgage thing becomes it's a bit like musical chairs, right? Like at some point in that daisy chain, somebody's going to have to get new debt, and that new debt is going to be
mm,
priced to prevailing prices, and then it all breaks down, right? It's like if I assume my mortgage to buy your house, then where do you go? Right? Do you assume
mm,
your mortgage to somebody else? And then okay, and then but eventually somebody, there has to be some net new entrant at prevailing rates. And for them, their purchasing power is just 20% lower as a result. And like,
yeah,
how does that work? So I don't see assumable mortgages as being a solution at all. Like to
I
me, that's
see.
just that's just a can kicking. Musical chairs is the best analogy I can think of because it's just like there's one too few chairs for the participants of the game.
And there's just
But
a liquidity premium that's sort of, supplementing the fair value of homes right now, right? Would you say that's true? If there are wide bid ask spreads, lack of transactions happening, then there should be some liquidity premium on a price until something breaks. Until
what do you mean?
until like
So what do you mean by that?
something breaks, meaning like the trend breaks, or some catalyst causes transactions to speed up. I don't know if that. I don't
Yeah,
know.
I mean, right. If there's a catalyst would be like massive unemployment or something like that. Where people had no choice but to sell. I mean, my
Uh,
view is like again I have this line like the indices are lying to you. And, they're not literally lying to you, but I don't think home values are worth as much as the indices say, right?
as
I
like
just
the
think that
notional value, the headline value.
like,
Yeah.
yeah, I think if we reverted back to pre-pandemic sales volume of existing homes and people actually had to find the clearing price, they would discover the clearing price is much lower. It has to be, right? For the
Mhm.
same reason that homes are unaffordable, that means the clearing price is going to be lower. Right? I don't even. It's this
So how do
bizarre
you
thing.
how do you how do
Yeah,
you short housing prices? I
you could. I mean, Parcel
mean,
has it.
it's already priced into the home builder stocks,
I mean,
but
right. I mean, the way to have shorted housing prices would have been to short low interest mortgages, right? Like I think that was the way to do it. The problem
mm,
is you don't have a good price discovery mechanism because there is very little is trading, except in the builder market. Like that would have been. I was actually long builders early, even before Buffett for I think for the same reasons he was, which was just like these guys are gonna they already had an increasing share of the market, but they were gonna be the only game in town.
mm,
And they would sell and they would move volume. And they had big balance sheets and they had plenty of margin to spare. And for 2 years, 2.5 years, builders dominated the market, absolutely
mm,
crushed it. But eventually that, they're also running out of run. They're all saying like demand is soft, demand is soft.
yeah.
Which is it's a weird thing in a housing shortage for builders to be struggling to move inventory, even with lower prices, incentives, and compressed margins. So yeah,
Mhm.
um, but yeah, I don't know that there's a good way. I mean, time will help. Um, I don't know that there's a good answer for it. Like, I don't know how. Again, I don't. If the fundamental problem is the interest rate, the 30-year subsidy that we gave some people, and other people now don't have. Like, I don't know how to do that other than just undo it, right? But
Yeah.
undoing it would be illegal and
The
pretty
Fed,
yeah.
I mean, the Fed could compress MBS spreads. It's not within their mandate, or at least they say it isn't. I kind of find it ironic that on um, that when rates were low, they were cognizant of housing prices, as a component of CPI. And now they're sort of agnostic towards the housing market, which to me kind of ignores the demand side uh, that mortgage rates are like the extent to which mortgage rates um, determine demand. But so right now they're tapering their MBS portfolio. It's like 2 trillion down from I don't know 2.5 trillion at the high water mark. And I mean they could. Who was it? I think it was an institutional research team did a study on it. Said that they could compress MBS spreads by 100 basis points if instead of tapering their portfolio, they sort of reinvested. Um, and so yeah, I mean that's interesting to me. Um, yeah, what are
I
your
mean,
thoughts
it's
on that?
true. I get they could. I mean, right. I mean, you could subsidize demand again. I mean, and I think what
Hmm.
you'd probably see is like not so much prices would. It's just one point of clarity. Like I don't think necessarily interest rates change demand. They do change prices. Like I think demand sort of is what it is, and then if you have cheaper interest, you can pay more for a house because
But
it's
maybe it would sort of catalyze transactions.
I think it would. Yeah, it would close
If we
the bid ask.
saw mortgage rates in a five handle. And I saw a story earlier this week, I think, talking about how buyers are staying put, potential buyers are staying put in anticipation of lower mortgage rates in the future, which is
Maybe.
kind of a catch 22 there. Um, so
I mean,
I
look,
don't know. I'm just thinking out
what we
loud
know
here.
is like what we know is that people again the amount it's actually pretty remarkable if you look at the time series like the amount of people pay collectively towards housing, not home prices because that's sort of a bad proxy. It's the combined monthly payment of the escrow payment basically is pretty consistently about 30% of
Mm,
of income or something like that. I don't remember the exact number. So like you know the question just becomes is like what are people's incomes, right? And then how do you find a price? The on price leads to that kind of monthly payment. So yeah, if you were to lower rates, you lower the borrowing costs such that people could stretch their down payment further, which is
hmm
then yeah, then I think the bid ask would close, and maybe what would happen is I think that housing prices would basically just stay flat at that point, but
mm,
maybe they would go up a little, but I think at that point people would say like I thought my house was worth $1 million. Now finally it is again, right? I think that's mostly how people would
mm,
react, and um, the issue from the Fed standpoint, and if they want to, that would presumably create, that would allow people to monetize their home equity and
mm,
would presumably be inflationary in other ways.
sure,
Um,
totally.
but as I was also the other piece of it too is like, okay, if you think your house is really worth whatever you say it is, and you're not getting a bid on it, then you can want to just take out a home equity loan and like monetize it that way. Well, I can't because my home equity loan will cost 7 to 7.5%, and that's not worth it to
Mm,
me. It's just like okay, then your equity,
yeah,
then your equity is not worth nearly as much as you think it is.
yeah,
And it is just like, and that's why people there's a point to people are wealthier than ever if you look at their all in wealth, and it's like not really if they can't if it doesn't monetize at all, like then it just exists on paper.
mm,
It's like looking at the NAV, the accumulated NAV of private equity funds and being like, oh, it's an
right.
all time high. It's like must be great to
Yeah,
be
but wait
private
till it
equity.
gets marked.
Right. Or no, they market high, but they can't sell it. So,
Oh
you
yeah.
know, it's like, or the best stuff has already been sold, but the stuff that's still
Mm,
on the books is just like it's marked above the clearing price. So,
mm,
maybe they'll be right in the long run. Maybe rates will come back down and they'll be able to fetch the price that they think it was worth. But like if you bought again any other commercial real estate, private equity, car, like if you bought a house or any of these assets when rates were 2% and then rates moved to 6%, like your asset is not worth as much just because people can't pay as much. And it's funny
mm.
because like in the car, go ahead.
No. Go ahead.
I was just gonna say because in the car thing specifically, like there are these periodic freakouts and they happen every now and again. Like when they show default rates, on cars going up, and you look under
Mm,
the hood and it's all from the 22, some of the 2023 vintages, and it's not a credit issue so much as it's an LTV issue, right? The problem is that the mortgages are now underwater, or the auto loans are underwater because the value of
Mm,
comparable cars, is just less. So people are walking away, walking away from these auto loans, but like their credit standing hasn't fundamentally changed. It's just like, if you look at car values too, car values spiked during the pandemic from $60,000 or whatever. And like, if the equivalent car is now 45 grand, why are you going to continue to, pay your lease on that? You're just going to walk
mm,
away. And that's what happened. So every
yeah.
time people are like, "Oh, everything's falling apart. Look at the subprime auto loans." It's like, no, that's not what's happening. What's happening is that the assets repricing and people are defaulting on these underwater mortgage on loans. But that
Mm.
yes, like that's sorry, yeah. But so that's kind of yeah.
Yeah, I wonder, kind of just in the back of my mind, and I'm sure this has been studied, is the idea that it's not necessarily the level or, yeah, it's not necessarily the absolute level of rates or let's call it monetary policy in general. It's about like sort of the whiplash that's created whenever you're forced to like hike at an accelerated pace or cut at an accelerated pace creates perhaps these dislocations on both ends of that spectrum. Um,
1,000%.
because
Yeah.
yeah, because I mean, if there was like a gradual increase from rates going from zero effectively to in the fours or whatever, I think we would have seen like markets aren't like there's a temporal lag, right? Like markets are, especially in capital intensive industries, there's going to be um, I don't know how you would phrase it, just sort of like these um, yeah,
Like
I mean,
like phase trend. Yeah, I mean, like, if what you're saying is like you can visualize the bid ask spread that currently exists by just looking at the Fed funds rate, right? Like, you see that big step
mhm,
change that happens. Like
yeah, yeah,
that
yeah.
step change is exactly that gap, right? And you see it, and
Hmm.
again, you saw it in 2008 and well, financial crisis too, which was preceded by a rate hiking cycle, right? I mean, that was the perception was like, the sort of broader theory, strong belief, weakly held kind of thing is just that as we've been experimenting with this for the last 30 years, is as organic demand, which is say population growth, begins to taper off, we've tried to fill the gap with, with cheap credit.
Right, but a
And
200 basis point rate cut creates like an acute demand shock.
right. Well, yeah, exactly. I mean, it
Hmm.
right. So that's what happens. Then we do this, and then we realize like, oh crap, we're over subsidizing. Like this is clearly monetary or policy driven, and then we begin to try to pull it back, and then we act surprised when there are empty houses in Florida, kind of thing. I was like, well, what did you
Yeah, yeah,
expect?
yeah.
You were subsidizing demand, and then you stopped, and now all of a sudden there's more supply than there's demand, and it's a bit of a rug pull, and that is that's what happened to SVB. Frankly, like maybe
Mm,
SVB's risk controls should have been
yeah.
better, but the Fed was out there putting billions of dollars, if not trillions of dollars of low interest securities and assets out there, and like who's going to take it? His banks are going to take it. That's what they're supposed to do. They're
Hmm.
supposed to buy that stuff. Just normally your wholesaler doesn't fall on its sword, so to speak, and like undercut its own prices, but the Fed can take it, right? The Fed's been bleeding money for the last couple of years because they pay more than on reserves than they get back on their assets.
I've seen
The
that.
Fed
So
can
basically,
afford it.
their net operating income has gone negative.
Negative, absolutely. And if it
Hmm.
was any other bank, there would be a bank run, so to speak, right? Like in other
Yeah,
words,
yeah,
they
yeah.
are in the same. They can criticize SVB all they want, but they're in the exact same position. It's just that the Fed doesn't go belly up, whereas the SVB can become insolvent that way.
Hmm.
Um, but
There
and
are
it's
a
never
lot of other
yeah.
banks that still have these sort of these paper losses that they're sitting on, and treasuries especially, right?
Yeah.
I'm sure you've looked into that. Like, what are the downstream consequences of that when those
And I'm not an
mature?
expert
Or
on this stuff. I mean, I think mostly what they've done, and I was kind of wrong on this actually, which I alluded to is like early on, I think like the BTFP, I still consider it as sort of one of the most underrated pieces of financial engineering. Again, I'm not an expert in bank regs, but to me, that's like sort of like saved the world from falling apart, and so nobody really pays attention that much to it because the world didn't fall apart. But what the Fed
mm,
did is it's like we're gonna basically accept all of these underwater assets at
Hmm.
face, at par. And so that stabilized everybody's, all the banks'
Yeah.
ability to stay solvent. And then over time, like, they start issuing new loans at the prevailing rates, and eventually their composition of assets begins to change
Hmm.
towards, NIM got, the net interest margin got pretty compressed, but it's starting to widen out a little bit, especially as like the curve, the curve begins to steepen. Where if rates come
Hmm.
down at the front end, but 10 years stay relatively high, because that's more of a supply demand thing, then
Hmm.
that's good for banks, right? Because the banks
Yeah.
like that widespread because they can borrow cheaply and then lend slightly more expensively, and that's kind of how it's played out, I think, at
Hmm.
a very high level. Um, there are still some banks that are like, OZK. I think it used to be Bank of the Ozarks. I forget what
Yeah.
still something like that. Like they've been very active in real estate, and maybe
Hmm.
they just did a better job of it. I don't know exactly, but yeah, I mean, the pain in commercial real estate, both office buildings, but generally, like it was sort of one of those train wrecks that everybody saw coming, and
Yeah.
it's manifested, but it's been managed, right? Like
Hmm.
people have lost some money, but there's been no broader contagion, and um, other than say like First Republic and things like that, which was not even a commercial real estate issue. But anyway, yeah. So I don't.
But I mean,
I,
there's zero building happening, and I don't know to what extent, like, sort of, what do you call them, redevelopments are eating into the existing stock of like sort of obsolete commercial real estate. Have you looked into that?
I haven't. But yes, I mean, I think you're right that new development has gone south. It's starting to pick up a little bit in some markets, but that's right, because like new projects just don't pencil at prevailing at higher
Mm,
costs. If cost of capital and cost of labor and cost of insurance go up, and insurance is a combination of cost of labor and cost of capital. Um, but incomes don't go up as much to support higher rents, then the math doesn't. It just doesn't work, right? And so
mm,
people have responded accordingly by not adding, as much new supply. And there's a great chart that Goldman puts out every now and again. I don't remember the exact numbers, but it's basically like, it shows the three variables of, incomes, interest rates, and home values, and it's like at prevailing rates and prices, incomes would have to grow, like, I'm making this number up, 40% for people to be, to get the purchasing power, to restore the purchasing power of the status quo ante. So, you know, it it's going to take a while
yeah.
before incomes go up that much. So the other levers, is the Zillow things. Like Zillow's like, well, if rates came back down to 4.3, then all of a sudden the affordability gap would go away. And it's like, yes, that's true.
Hmm.
Which is telling you it's not a supply of housing issue, it's a supply of cheap credit issue.
Mm,
Yeah, so I think either rates have to come down, incomes have to rise, or prices have to come down, or some combination of all three. And how that plays out is going to be right. It's going to be some exogenous factor. Like if people have to sell for some reason, not presumably not any good reason, that would certainly bring prices down. Or just over time, the incomes will go up, and people will slowly begin to afford, afford the asking prices. Um,
mhm.
but yeah,
To what extent do you think construction productivity plays a role in this? And additionally, with sort of the AI capex build out, I wonder how, to what extent that's tapping the same human and material resources construction wise as home builders. It's a very fragmented industry, right? It's like
yeah.
highly regionally dependent for a number of different reasons. But um, I wonder if you've looked into sort of the state of the construction sector. The Ford CEO, I think, was on Bloomberg yesterday and said, was like sort of pounding the table, saying we have a labor shortage, skilled labor shortage. Um, I wonder if you thought about that at all.
I mean, I have. Yeah, in a few different dimensions. I mean, we do absolutely have a skilled labor shortage, especially like skilled trades, like HVAC, especially.
Hmm.
And that skill set is not necessarily the conventional HVAC. It's like HVAC for cooling, for data centers, right, to keep the chips from melting themselves. Um, you know, look, the construction productivity stuff, like, people like to point at it, and again, NIMBY's like, oh, it's, they must that the reason the construction productivity has stopped improving is because of NIMBYism, and like, again, I don't buy it. Even if you look at like, they the time series that they produce, like a much more plausible explanatory variable again is again changes in interest rates, not NIMBYism. I think I don't know that there's any universe where you could build scattered site single family as efficiently as you build and maintain multifamily, right? Like there's just
Mm,
operational efficiency to density from, and again, if you talk to like the scattered site single family developers or asset managers or property managers, like it's a hard problem, right? You much rather have, property management over a community where you can have a single maintenance guy who serves the entire set of houses than have houses all over the place. And either your maintenance guy has to drive 3 hours to do one visit, or you have to have like this kind of fragmented supply of Uber mechanics or something like that, where you can
mm.
get them to where they need to go. Like that's just a structural problem that I don't think I don't think anybody's necessarily solving anytime soon. Um, that it is what it
There's no
is.
like
Yeah.
franchised construction services. I guess probably on the services side there might be, right? I mean, there are like industrial companies that are multi-regional.
There's
Um,
certainly big
but
there are big ones like Comfort Systems, that does big industrial projects, but not yeah.
mm,
But they
you just
also
hear a
need
lot of
like
times that there are there's a lack of economies of scale
exactly.
structurally to your point. And then on the material side, I mean, like uh, sort of there's this trade-off. Joe Weisenthal on Odd Lots had a Substacker on who wrote a book on exactly this. Is like innovation in construction. There's a graveyard of dead startups that have like tried to solve this problem. Where I mean, at the end of the day, you have to like if you want to do modular, you have to design it such that it doesn't break whenever it's being transported on a bumpy road. So it's not just about the structural integrity in its final state; it's about like the intermediate state as well. That adds all kinds of layers of cost. I know.
And you need incredible demand, right, to make the unit economics work. It's like you can't build a
Mm,
car manufacturing plant and sell 10 cars. So
yeah,
you
yeah,
need to
yeah.
be able to, if you're going to mass produce houses, you need a mass
Needs
produce
to
end
be in an
market.
upcycle.
Right. And also, but you have to have demand for so-called cookie cutter, and like they have to be able to fit in all the different, yes, could you if you made every plot in America roughly uniform with the exact same building regs around it,
Mm,
it would certainly work a little bit, but then you'd still also need demand for everybody's houses to look exactly the same, which they don't necessarily want. Like people like to personalize. But
mm,
also, anybody, if you ever, have been close to a construction project, like shit goes wrong, right? There's always,
yeah.
oh, like, oh crap, like we were just digging and it turns out there's a huge, unmarked water main or something. Like there's just stuff that happens that makes it's not a closed houses are, out and assembled in the world, right? Cars get manufactured in a plant and then they go on roads and like, yeah,
Mm,
but it's just it's the friendly versus unfriendly environment stuff. Like you can mass produce things where there's a very highly predictable supply chain and you can control every component of it. The more that you lose control over, the more variation, the harder it is to mass produce. It's like, why is it in some ways cheaper to build a car than it is to fix it in a crash? Right? Because building a car is
mm,
highly repeatable. All the component parts fit together. You can get it down to a science, whereas crashes are chaotic, right? The ways in which things break is unpredictable, and
mm,
how they interact and how it breaks down the system, all of a sudden it then becomes a custom job. And so you know, chaos forces customization in some ways, and so do preferences, but so does just like the chaos of the real world.
mm,
And building, and again, it's not Sim City, right? Like where you just say, yeah, these are my lots, and I'm now going to build houses there, and they're basically work, as a commodity. I think we've done actually an amazing job along those lines. Like I think some of the biggest home builders do exactly. I think get criticized for it, right? That people will put pictures of some new Lennar development or something like that, and be like, look at these cookie cutter gnome houses or whatever it is. And it's like, well, that's what that's
Yeah, there's
production looks like.
trade-offs in life.
Yeah, exactly.
Yeah.
Um, or you get the other end of the spectrum, which I think are these fairly ambitious projects like cul-de-sac, which I mentioned. If you ever seen it, you should check it out. Like where they basically just ground up,
You said in
develop.
Arizona?
Yeah, I think they're trying to do it elsewhere where they built, car-free single family. I think it's a mix
Uh,
of stuff, but they built the whole thing, right? Like they built the whole town. It's
mhm.
how repeatable emotion is that? I don't know. I think maybe you could do one at a time. Could you do 10 at a time? I don't know. But I'm not.
Purpose-built,
I think
car-free. Are they doing that in tandem with like public transit?
good question. I
Like,
don't know that there's like how much public transit's in Phoenix or in Arizona, wherever it is.
that's like
Scottsdale, maybe
Tempe. Yeah.
Tempe. So probably
Mhm.
not. I think more they, maybe there's like public transit that exists at at one node of the place. I mean, maybe internally there's public transit, like,
Mhm.
but to connect it to some place where people work, that I don't know. Which, by the way,
I wonder why the Yimbys don't talk about this more often. I haven't seen it at all. I've seen the California Forever project. I don't know if you're familiar with that, like the billionaire funded
yeah,
uh
which people
thing on
shout on.
California.
Yeah, I like those things. I think those are,
Yeah. And it's gonna be
I think
wildly expensive.
sure, right. And that goes to the exclusivity point is like,
Mhm.
there's no like what would it take to build like New York City such that everybody who wanted to live there could afford to live there? Like, it's almost like the Matt
Mhm.
Iglesias, 1 billion Americans thing is like, it would maybe you could continue to put barnacles on that sea vent, such that you can meet all of the world's demand to live in New York City, but it would be a very different place. And yeah, I
Mhm.
think that place, Mark Andreessen and the college, whoever else, all those, yeah, I think people are going to want to live there, and it's going to be very expensive, and the number of people who would want to live there is a lot. Um,
Mhm.
I mean, the number of people who get, wealthy, there's a lot of wealthy people in the world. And, if they begin to focus on a small handful of places where they want to live, then prices they're going to get bid up.
Mhm.
Yeah, I don't know why Yimbys don't talk about it more. I mean, partly I think it's because I call a lot of them so-called fair weather Yimbys. Like there's no other part of the broader economy that they want to YIMBY. Like I'm like a big fan of what I call healthcare YIMBY. Like I think we should be broadly
Mhm.
deregulating healthcare. There's no other part of housing that they necessarily like. I'm like, okay, why don't we do away with OSHA? Or why don't we do away with Fair Housing Act for like those are
Mhm.
also regulatory costs. Like, if you you could do away with those first, but like they seem very singularly focused on, and not entirely,
Supply
like
side progressivism.
it's all but the thing that they really don't like is single family zoning in the suburbs. And like, it's
Mhm.
like if that's that then I begin, what I become suspicious of is like it's not that you don't like zoning qua zoning, is like you just don't like the fact that some local township gets to control it rather than you. You'd rather roll it up, at a more
Mhm.
central level where then you get to decide, who lives there. And I made this joke, and it's been prescient. It's like when demand for data centers and land to put them becomes so high that people want to build them right next to places where people live. Let's see how if the Yimbys lose their religion, kind of thing. It's like all of a sudden it's like, oh wait, hang on a second, you can't build a data center right if people want to live here, and it's like, I
Yeah.
told you. But like there are other people, I'm being unfair, like other people who are like, no, like building code is to got like parking, setbacks and things like that. And, people, lots of regs around fire and electricity that are kind of optimized for harm reduction, but aren't necessarily like, makes, yeah, the fire inspector wants to bring fire risk down to zero, but it might be excessive relative to the actual risk reward there. I mean, I'm sure
Mhm.
there's some of that, the elevator stuff,
Yeah.
ADA stuff.
Yeah.
There's a lot of other ways in which we constrain the form factor perhaps more than it should. Um, but
But
yeah,
I mean, it sounds like there have been quite a few YIMBY legislative wins, especially in California, but across the country. So it sounds like I mean, there's sort of, I guess the proof will be in the pudding. Um, Minneapolis is an interesting example that, sort of the first wave of upzoning didn't really yield predicted results until more was done, and uh, well, the Yimbys are claiming it as a win. This guy Mike Fellman, I don't know if you're familiar with him, would object to that, but at any rate, I think it's like I wonder, and I think we're coming up on the hour, so I want to be conscious of your time, but I wonder sort of what the downside is. Like, what's the risk reward profile of YIMBYism in its limit? And I guess like what is the risk of it?
Well, again, I don't view it as a monolith, but I think it comes back to what do you define as a win, right? Like, if everybody lives in people hives, right? Like it's Hong Kong or, Singapore, something like that. Like, yeah, the home prices might be more affordable, but is quality of life necessarily better? Like, are people having families or, right? In other words, like, I think so you have to, I think, be more precise about what you consider a win and just bringing home values. Like home values are, pretty cheap in some of the, or I like to joke,
Yeah, let's
I
say,
think we have this exchange, like the best way to bring home values down is to introduce crime, right? Like
yeah,
make
totally.
the neighborhood more dangerous. Home
Yeah,
prices will come down. Is that a
I would say
success? I don't think so.
like let's say the goal here is to make San Francisco more affordable, and that means either home prices, in the nominator or income in the denominator. Uh, one can change without the other, and sort of mediate affordability. Um, there is some good research I've seen on just like the sort of GDP impact of these spatial misallocations, where you could have more productive and efficient cities, not necessarily cheaper, probably not actually in many cases, um, but that they're, just it could unlock productivity through agglomeration effects. It could also backfire to your point where, if done improperly, that then you create negative amenities. While affordability may increase, it actually long term sort of drives people away to other cities,
Right. You've
etc.
lowered the quality. And again, I
Yeah,
think part of the downside is, do you kill the goose that lays the golden egg? Like it's very hard, going back to the university analogy, like it's hard to create a, a critical mass of exclusive human capital,
a
whatever you want to call
superstar
it.
city or an elite
Right. And
institution. Yeah.
it's very hard to create that stuff. And if you break it, the people, then you might, then that's what you have. That's the potential for losing it. It's like, and I keep going back to the same thing. Is just like, what people really want is the suburbs, right? Like that's where this most, it's like, people used to shit on the suburbs and then move to the cities. And all of a sudden the pandemic came and everyone's like, hey, we want to go move to the suburbs, and they won't give us the welcome mat. There must be a bad governance problem on their part. It's like, that the lesson should be is like, oh, people really like suburbs. We should figure out how to have more of the places that look like that, not say, how do we make these places look more like the places that everybody's fleeing from, right? I
Mhm.
mean, and that's, I think, is the downside is like you just start stacking, high rises in places that people clearly want, and then you make a scarcity problem even worse, which is like now there's no nice places to live. The
Mhm.
only choice you have is a stacked low trust high rise, and it gets worse. I think that's some of the downside, and people like to look at Robert Moses and some of the big projects that were done in very much the same spirit in the 60s and the 70s, where
Mhm.
we're going to take these neighborhoods and we're going to destroy this light and we're going to rebuild there. And we're going to put housing projects and it's going to be great because look, we built a park right in the middle of the house and we study this down to a science in terms of what people want and how they interact with the right ratio of sunlight to, and it's like, nope. Yeah. It turns out you build a giant concrete block in the playground. Nobody uses it. In fact, like it's all broken up, and you can't just manufacture, you know, or there's too many variables at play, and you can't centrally plan this stuff.
Yeah.
And again, like to me, coming back to NIMBYism, it's like they haven't learned their lesson at all. nor do they have any humility of like the sort of intellectual tradition that they came from, which is like you guys have made some mistakes. Like why 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 is it that you feel this you have this continuous authority to prescribe what policy ought to be? And, and if your track record is what it is, and it's just like yeah. So I think that those are the downsides. I mean, it's also even just more broadly, like I think it's a solution. It's a solution to it's a non-solution to a non-problem, right? Like
Mm,
you're prescribing a remedy for a perceived problem, which is not actually NIMBYism isn't actually the problem. Maybe it's a small problem at the margins in some places, but in the big scheme of things, it's not the issue.
mm,
And so like that's sort of where yeah I don't know that's where I'm much more like I think NIMBYism in big cities like already dense places I think is much more defensible and NIMBYism on other dimensions that aren't necessarily having to do with density, like building code stuff, and are much more defensible. Um,
mm.
but
So on the periphery,
yeah, or maybe they're not
but
on the
not the
it's
everything
just not
bagalism.
right. Not the just build more, just build more, just build
Mm,
more as this kind of uniform every day. To hammer everything's a nail. I think that seems bad to me.
mm.
It's fairly short termist because like once it's done, it can't be undone or not undone easily.
Yeah.
Um, yeah.
Couple questions before we wrap up. One like regionally speaking, where do you think the highest rental yield for residential? Where do you think developers are looking to as the next growth market?
Good question. I don't have a great answer for that because I can just see what the data is showing. I don't know where they're thinking steps ahead. I mean, I think it's
Hmm.
still largely the same. It's still the southeast because even though there's there's a lot of supply on the market there, there's also still demographics are on their side.
Hmm.
Although of course with the change of the administration, somewhat less so insofar as just there's fewer there's less migration to support net new demand. But even
Hmm.
so, like Texas is still a net gainer of people. Florida is still a net gainer of people. So I think people are still building there. And, um, I think if you can find places, it's at a much smaller scale. If you can find places to build in the Northeast, like, you can make some money. Certainly rents have gone up there, but, there's much less net new demand, or less space physically to
Hmm.
build new stuff. Um, but I don't, I think, there's some intention. I think people are trying to get hip to the observation that people like this sort of mid density, the sort of smaller, this
The
three, maybe
missing middle.
yeah, like in the Park Slope style of like maybe, maybe one or two split family or something like that, or, three units in a building. Um, but then that comes back to the economies of scale issue. It's just like, it's harder to build. It's much easier to build one big people hive and in
Hmm.
unit economics work than building a small 3-person townhouse one at a time. That's just and some people do find that niche. Like they just like no, our expertise is are precisely those things in very select markets like the West Village or even Rochester or those. But like you can't put there's only so much money you can put behind that kind of strategy. You're not going to get a $500 million facility from KKR or Apollo or whatever it is to do that just because you couldn't possibly put that much money to work doing that
Hmm.
kind of thing. Um, and I mean, that's sort of another interesting thing is just like who is funding that stuff where these more, these niche strategies that probably don't work at scale. And like that's a sort of separate problem. And there are people working on it. Like my friend Brad Hargraves, he's sort of taken a path down to like how do you make capital markets better for more niche strategies sort of thing. Sort of talked about it. I did an interview with Lance Lambert, who's really
Hmm.
smart on housing, and he mentioned that actually a lot of the big builders, are providing some of the financing for some of this niche stuff because
Hmm.
they have the balance sheets to do it. They know the markets really well. They have good relationships, and for them, it's a little bit of a call option. It's just like if the strategy works, then I can acquire it and I can
Hmm.
deploy it at scale. But this is like a good R&D function for them. Um,
Interesting.
but it's a little bit harder, if you want to go out as the chicken and egg problems, like, okay, if I want to build a lot of stuff, well, I need reliable capital behind me to do it. Well, how do you get reliable capital? You go to a big somebody and you say, well, look at all my track record and look at my pipeline. Um, and that works for existing legible inventory in a playbook that everybody knows. But if you're trying to do something new and different, like fundamentally, you can't come to anybody and say, "Look at my track record, look at my pipeline," because what you're doing, almost by definition doesn't have that. And so then
Mm.
it does. And I was like, well, how do you build that track record? So you have to find somebody in the middle there who's willing to finance that stuff. And that also comes back to the Fannie Freddie problem. If you want to talk about a distortion, I think is underappreciated. It's just like Fannie Freddie, right? They will lend, and banks, there's a daisy chain where it's like, I will lend against something that I know somebody else will buy. So it
Mm.
has to be highly legible. It has to be very conforming, like literally using the word conforming, right?
Yeah.
Because I'm not going to put a lot of money in a project that some other lender might turn around and say, yeah, no, it's not inside my buy
Yeah.
box. And actually, it's fun. Like Brad talked about that. He founded a company called Common, which was sort of one of the early, it wasn't like WeWork, but WeWork-ish, is sort of a little bit more joint housing. And one of the biggest challenges that he had unexpectedly was just that banks didn't want to touch it because it was not squarely within something that they've underwritten before. And so they didn't want to lend against it, because they were worried basically that the debt
They didn't understand
wouldn't
the
be able to
risk profile, probably.
not even if they could understand it, they're concerned, well, is somebody else going to understand it, right? Because that's the thing, is like, that's the sort of Minsky cycles. Like a lot of how debt works is premised on the idea that there's going to be another lender after me.
Mm.
It's certainly in the more mature,
Yeah.
like RMBS markets. So like if you can't, and it goes back to the point on Fannie and Freddie's. Like partly what Fannie and Freddie did is they almost a guaranteed end buyer of this kind of loan, which then allows lenders to turn around and say, okay, I'm going to issue these kind of loans because I can put them in pools and I can bundle them up and I can sell them. But if your loan is for an asset that's a little bit different, and then there's no pool, it can't be bundled, it can't be sold. It's like, well, do I really want to be? Do I want to be in this
Yeah.
business?
I, I
Um,
I wonder
yeah,
on that front, like whether there's whether this is being thought about, the idea of having maybe like three to five different um standardized products that run through Fannie and Freddie. Did I lose you, Moses? Hmm.
oh, I'm back. Sorry, I
Oh,
lost you
okay.
for a second. Yeah.
Yeah, no worries. I was just saying, I wonder if anybody in the administration, or Bill Pulte or anybody, is thinking about the idea of maybe expanding sort of uh, the standard product line at Fannie and Freddie, to different types of products um, that could give some optionality. I don't know.
I don't know.
It's
I mean,
interesting.
again, I doubt it. I mean, economies of scale are what they are. Like, it makes sense if you're a big bank and you're trying to strategize how to deploy, hundreds of billions of mortgage-backed securities, that you want some uniformity in what you're deploying against.
Mhm.
So like even, there's a logic to it, even if it creates some trade-offs. I know customization is just more expensive because it's less repeatable.
Yeah.
That is what it is. I mean, I haven't been terribly impressed with Pulte, and I think, I don't know, I think part of the issue and like why Indiaism is so popular is because there's so many different people who support it, but for very different reasons. Like I think real estate, obviously, like they love it but also like a lot of it is because they get to make money off of
Mm.
flow and off of transactions. So like, if lower rates means more houses start trading hands, they don't really care about the affordability. They care about transaction volume, right? Like agents
Mhm.
make money off of the transaction volume. Originators make money off of issuance. So, um, they're for them, like just ungluing the market is valuable because they're taking, bips off of flows, where values end up in terms of like, that they don't, they're sort of somewhat more agnostic to that. I think
Mhm.
Pulte very much falls in that gap. Is just like, yeah, sure. Yeah. He wants lower rates, and, it'll certainly unglue the market and people will start buying houses again. And, but longer term, yeah, I don't think he's thought it through that far.
Mhm.
uh, you know, um,
All right. Last thing, we're almost in November, so we're gonna start getting the 2026 takes. What's a big take of yours looking ahead to 2026? What are we going to see? Maybe on AI, maybe on housing. What's caught your eye?
it's a good question. It's funny because like so much of maybe, rather than focused on or at least been interested, it's like a lot of it has been my calls for the last couple of years it's been a lot of victory laps and stuff. You're like, see, this thing that I was talking about, is now increasingly becoming consensus and manifesting itself, and and still there, like with labor market stuff, like, oh, labor market's so slow. I'm like, it's not. It's slow as it ever was. You just confused the catch up for growth, and now that we're all caught up, like, yes, growth is going to be organically slow. In terms of like modeling, a a view of the future. I mean, it's hard enough to know what's going on now, let alone what's going to happen later. I don't know. I don't have any big, profound. I think the sort of interesting things that I'm watching are like, actually, can am I wrong to the upside? Like, I think that growth is going to, the middling option has been my base case for a while, and that's sort of how it's manifested as low employment growth. The only pro cyclical industry right now is AI, and it's not terribly
Hmm.
labor intensive. Healthcare is the other one, but it's not pro cyclical, and we can't afford
Hmm.
it. I'd like to be wrong, right? Like there was this Trump bump, which did show this spike in hiring and investment, and like I was kind of skeptical of it then because I'm like, I don't see what's changed. But and then it kind of, it mean reverted, and everybody's like, he broke it with tariffs. I'm like, I don't think so. I think the Trump up was fake, and so was the breaking. But maybe I'm wrong about that. So like, it would be fun if for some reason some other, the sort of best version of the Oren Cass model of the world, which again I'm pretty skeptical of, but and maybe he's right and will work out. And all of a sudden that you'll start to see unemployed people coming off the bench and
Hmm.
finding new ways to put them to work, and that would be kind of cool and neat. The other thing, of course, yeah, is the AI productivity gains, which everybody's watching pretty closely. It's not really productivity; it's just can it capture a return on equity, that's
Hmm.
roughly comparable with what the market pays, and that's what will keep it going.
Hmm.
Um, and I think that stuff, that's kind of an interesting thing to watch. I mean, you've seen some really impressive, like Google Cloud revenues reaccelerating, 35%, which is just crazy for a multi-hundred-billion-dollar business. Like people are definitely spending on it, whether they're using it in ways that are productive or they're still in experimentation. It's you get different answers depending on who you ask, but um, certainly code gen is that that's not coming back, right? Nobody's going to go back to a precursor or a Copilot view
Yeah.
of the world.
Right.
I also like the other stuff that I like. I think AI is a job maker, not a job taker. Um, and I
Hmm.
think so far I've been right on that to the extent that the evidence shows anything at all. So I think that'll be kind of interesting to see like what kind of, like the Tyler Cowen line, service, markets and everything kind of thing. Is like what new kinds of jobs, in other words, if before the energy revolution, nobody would have been in the lighting business, right? Because like,
Hmm.
what lighting business do you have? You burn whale blubber or whatever. But then all of a sudden, energy becomes cheap, and then you can do uplighting on your construction buildings, and it's like a whole other
It's
industry
just
that we never
creative
even.
destruction in in the
Yeah,
labor market.
it's great, but it's
Yeah.
also like, it's like the invisible graveyard. It's like we don't yet know the things that we. It's like the Ford line. If you ask people what they want, they say they want a faster horse, right? Like what is our, what's our automobile to the, if we're driving horses now, what's the automobile going to look like? And I don't think we really know yet.
Hmm.
I think that stuff is kind of fun and exciting. Um, I don't, and I haven't chastened bear like like everybody else. I thought was pretty confident that we would have some kind of recession in 2023, 24 when, when we hit we hit the Donna Summers phase is what I used to call you, Stimmy's, you got to work for your money.
Hmm.
Hasn't happened. Like employment's been pretty strong, and, it's not great, but like people are employed, they're still spending. So that's fine. Like I kind of think that's going to continue to be the case. Um, it's not the most impressive story, but it's not doom and gloom either. I don't know. I don't know what bold. I still don't fully like. I kind of understand the gold stuff, but it still seems overbought, kind of crazy. Like you're like, oh, people are delevering from the dollar, and like it's actually not quite
I don't think so.
true. Yeah, I mean most of the people like look. They like to point to gold's share of reserves as having increased dramatically, and it has, but most of that's been on asset
Mostly
price
China.
appreciation. Well, but it's also it's appreciation of it's just price appreciation, right? If you just it's not necessarily a volume thing. It's just that the volume that they have has just gotten way more valuable. Yeah, it's China, it's
Yeah.
India, it's BRICS. Like it's we know who it is.
Yeah.
Um, but I've also like I've sort of been I said the fade America trade. Like I think the tallest midget logic still very much applies, and um, whatever it is that Europe or even China will do, it's like people got to put their money somewhere, and the U.S. is still the
Mm.
best place to do it, and so they will. And in fact, the word if
And they
again
still
without
control the shipping lanes. I mean, there's
yeah,
that.
but also like if we whether you like it or not, like if we sort of if our policy hurts European economies, it's not like money. I don't that then it's just going to make our comparative advantage that much more. And instead of money flying to Europe, it just even more of it flew here.
Mm.
Um, so uh, I don't know. Like, I guess I don't know. I don't have very many. It's almost like I'm on the lookout for the big change, and I don't know what it is yet, other
Are
than the
you,
obvious like AI stuff. Yeah,
let's say we're talking about QQQ. Are you above or below consensus on 2026 returns, whatever that may be? I'm sure it's like
I don't know. Like it says,
7%.
I'm still long for the most part. I mean, I'm long with apprehension. I have some, I have some allocation that I wait for buying. I've been a dip buyer. Like I kind of my most of my you know thesis. Not entirely. Like you can break it. I mean, there's some things that like at the lower, this mid cap level where I sort of look for companies that have some tailwinds at their back that may be underappreciated. Like whenever I can talk about this, but like mostly like I bought the DeepSeek
Mm.
dip on Google. Bought the Liberation Day dip. I'm prices are high, but earnings are growing exceptionally well, and um, I don't. Yeah, I'm generally long on those names and wait for freakouts to for more attractive prices, um, which has worked out pretty well. Um, and then yeah, I guess if there's no evidence that capex is slowing, and everybody is building to what they claim is existing demand, and nobody's you know there's no the analogy to fiber, the so-called, it doesn't hold,
Mm.
right. In
Yeah.
2000 it was all so-called black fiber, and black fiber just meant fiber that nobody was using.
Mm.
David George and Andreessen Horowitz just sort of and with what's his name uh, head of a trades. Like I can't remember his name, but Gavin Baker, basically made that point. Is like, they were building lots of fiber, black fiber. They called it black fiber, which was good branding, but it just meant fiber that was not in use. There's nobody's
Mm.
building black GPUs. The
Mm.
issue is that GPUs are melting because
Mm.
because there's so much demand. And I don't know, maybe you know, if there's some other big secular shock that causes everybody to kind of tighten up. That yeah, it's hard to predict those. Um, but these shocks that I look, the healthcare stuff is real, right? Like in other words, if the Obamacare subsidies go away, and all of a sudden that cost has started to pass through on the managed care side, and it hits employers. Employers see it before employees do. Like that's real. The energy
Mm.
shock is potentially real, right? If demands for energy are such that the cost of electricity just it's really a transmission problem and a generation problem goes up, somebody's going to have to eat that cost, and maybe that puts some damper on demand. But I don't know. Yeah, I'm long, generally long. Like
Mm.
yeah, I think, and I think markets are much more rational than people are giving them credit for. Like they're pretty, everybody, I think Meta announced it was going to spend more on capex, and its price got crushed, and it's like, okay, bubbles bursting. It's like, okay, but Google announced that at 30, is also increasing its capex, but it had 30% growth in
Rarely
21.
would you see companies increasing capex during a bubble burst.
Yeah,
I
I
don't
mean,
know. Yeah.
it doesn't make sense, right? But the point is that shareholders are also, they're pretty discerning, right? Like they're looking at earnings, and they're looking at cash flow, and if you grow them, they will reward you. Google's are growing, so they'll pay more, and
Mm.
Meta's also growing on like Instagram, but not growing quite as impressively. And yeah, if you say I'm going to spend $10 more billion than I thought I was, then then you have to, the model changes and your margins compress a little, and so you're going to see a haircut to the price, but that doesn't mean the bubble's bursting. Um, yeah, I mean,
Yeah,
there's risk in the system, sure. Yeah, there's more debt there, and yeah, but I don't know. I guess is that the contrarian take is that it's not a bubble. I guess not yet, at least.
I think
Um,
I think before the trend breaks, we would need to see something like a shot across the bow of the core thesis on AI, something like what people might have thought in the moment the DeepSeek revelation was. But I'm not sure what that is. I mean, you know,
yeah, I don't know what it is. Like it's because the issue is like, and I do have to jump, but like I
mhm.
don't even know how to pronounce it. Javon's paradox. In my head, it's just Michael
Oh,
Jackson's. Just
right, right, yeah,
cheaper. And it's like the cheaper this stuff gets, the more people want to use it.
mm,
So, people, the first crisis, is that, oh, there's going to be this glut of GPUs. And if you look at the price of GPUs and compute, it's gone down and it's going to be oversupplied. It's like, well, no, actually, the response to cheaper compute has just been more tokens.
mm, yeah,
And we're so far away from
AGI,
I don't know, we're so far, or just figuring out what we're going to do with it. The idea that
mm,
we've, hit peak oil, so to speak, or hit peak compute, it just seems pretty far fetched. There
yeah,
again, like, there's some things that you could be raise an eyebrow at, whether it's like some similar web data that shows, that some of the cursor acquisition is slowing down a little bit, or Ramp does their credit card spending data. It's just some of the adoption of the top end might be slowing, and it's like maybe, but everybody I talk to, and I think it's true, is like they would pay 10x for cursor than what they're paying now. So like
mm,
there's just using a cursor as an example, but like so there's more pricing power than these companies are currently holding.
mm,
Um, yeah, I don't. I mean, to me, I think the thing that would happen would have to be not AI related so much as something else related that just causes people, to tighten, and and maybe it's the sort of more bearish views of just that population growth is just too important to GDP.
mm,
And that as that has slowed down, it begins to slow even more than a lower break even. And actually the problem is just like we don't have enough good productive things to put people to do, because AI is not terribly labor intensive. Like
mm,
data centers don't require a lot of people. And there's nothing else pro-cyclical that's firing it right now. So that could be a problem. But
mm,
that's a long problem in the making. Um,
yeah,
yeah. It's like,
uh,
again, it's the same as the rock and hard place with healthcare. It's like, it's true. We are unsustainably paying for healthcare, but if we were to pull that back, if you thought job growth was bad before,
yeah,
yeah. So I
yeah,
don't know. It's yeah. As I say, it's hard enough to predict the present before it's predicting the future. But yeah,
right. Cool. I think that's a good place to leave it off.
yeah,
Really enjoyed our conversation, and hopefully maybe we can do it sometime soon again.
for sure. Yeah, no, same.
Yeah.
It was a good time,
Thanks
and I
everybody
like
for
what you guys are
joining.
doing. I think
Yeah, thank you.
the Boyd Institute stuff is it's good. I think even if I don't
Yeah,
agree with it all, that makes it
we're
better.
kind of
Yeah,
just we're kind of just trying to think out loud and treat it like a VC. Like we may miss the mark on 5 or 10 bold asymmetric ideas, but hit one home run that makes up for the rest. And
yeah,
yeah, so that's our approach right now.
makes sense to me.
All right.
All right,
Thanks,
guys.
Moses, and
Thanks very
see you
much.
everyone. Yep.
Bye.
Bye.